this is Strictly Money, and I'm your host, Saijal Patel. Thanks for watching. Swiss bank UBS recently named Toronto one of the world's bubbliest housing market, and that the latest price surge of another 35% since the pandemic was not sustainable. Okay, there have been warnings like this for many years, and Canadians have largely ignored them. But with interest rates on the rise and an impending recession, maybe, just maybe, this time is different. David Larock is president of Integrated Mortgage Planners, and he's back with his insights on the housing market. Hi, David. Great to have you.
Thanks, Saijal. Great to be here.
So what do you think? Is this time different?
Well, I think we should always be wary of the phrase, this time it's different. But in this case, maybe. It's really, I think there's a short-term and a long-term answer. In the short term, rates have tripled and we have record high debt levels. And when you look at the price of housing in the GTA, prices have been so high that has necessitated higher debt levels than in other parts of the country, save for maybe Vancouver. So over the short term, no question, you can't triple rates on very high debt levels and not have that impact the market. Now, the stress test will help because when rates were 1.5%, people were being qualified at 5% or 5.25%. And that was an important buffer in the market, and we're benefiting from that. And there's really no question that in the short term, buyers are looking at the market saying, my cost of borrowing has gone way up. I can only afford to buy at a lower price. But sellers are saying, I want the prices that were available in February. I'm not willing to accept a lower price at this point. So everybody's kind of in a standoff right now, and it's not entirely clear who's going to blink first. Yeah. I think we'll find out next spring who ultimately does blink. Yeah. The other side, though, of the argument is when you look at more long-term factors, we have record high levels of immigration into Canada, and about a third of the new immigrants to our country come to the GTA. And that influx of population is going to ensure that demand stays robust for housing. We have a shortage of available housing. That's been well documented. And the other thing is, if you're not going to buy a resale house, you're going to buy a new construction house, or you're going to build a new house. Development costs went up 50% a few months ago and are onerously high. So really, how can the price of housing drop by 50% if the cost to build housing is significantly higher and we have a housing shortage? So really, those are the two sides of the argument. I think over the short term, there should definitely be downward pressure on house prices. But over the longer term, when you compare the replacement cost of housing, i.e. the cost to build new housing, it's still quite high. And I think that is going to put a floor under prices. But again, I am not bullish short term, but I think long term, 10, 20 years from now, I think there's still an argument to be made that barring short-term price corrections, that the supply-demand fundamentals and the replacement cost argument are still compelling.
Yeah, it's interesting that you talked about people, the sellers hanging on to higher prices, because I am noticing that. Even though there's a lot of talk about housing activity down in major cities, do you think that they're going to have to kind of cave in and that we should see some more downside for housing prices?
I think so. The other thing people have to remember is not everybody has a mortgage on their house. More than half of the properties, residential properties in Canada, don't have a mortgage on them at all. And those people are under no pressure based on what's happening with mortgage rates. Certainly, there's a subsegment of the market. People who bought a couple of years ago when rates were 1.5 are now under pressure, especially if they maxed out their borrowing capacity and prices have fallen. They might be a little underwater right now, no question. But those people just bought, and a lot of the people buying back then were of the mind they were probably buying when prices were frothy, but they were doing it long term, and they were willing to ride out a short-term change in prices if they felt like they were making a good long-term investment. So I don't think those people en masse will be overly swayed if they can continue to make their payments. And there's lots of other factors to consider. In the end, we'll find out, I think, the next time a lot of inventory hits the market, who is under more pressure to adjust their positions. It'll be buyers or sellers, and then we'll know.
Yeah, it'll be interesting to see. We only have 15 seconds until the commercial break. Are you noticing big differences though, GTA or anywhere where it seems to be more stable?
Not yet, no. I'm noticing inventories are low and the market has certainly slowed, but I think a lot of people are taking a wait and see approach right now.
Okay, we're going to take a quick break and we'll be right back. Welcome back. You know, David, right now it feels like there's this fear that if home values decline far enough, maybe even fast enough, that some people will see that the market value of their home is less than their mortgage. And I have to think that's probably for newer buyers. What are your thoughts?
Well, there's certainly, I think people should expect that prices are going to decline. The question is by how much? Are we going to get a dip or are we going to get a crash? And any homeowner who's bought recently and borrowed to a high degree certainly would be worried about being in a negative equity position where the mortgage was worth more than their house. Um, but again, we really don't know. And I think I want to be careful about sounding overconfident in my predictions because we are in volatile times and there's a lot of uncertainty in the market. I would say this historically, even in rare cases where Canadians have been underwater on their mortgages, they haven't, quote unquote, mailed in their keys, which is when they put their keys in an envelope, send them to the lender, move out, and say, here, Mr. Lender, the property's yours. It's your
Right.
problem now. Closest example we have is in Alberta in the oil price crash back in 2015, and that didn't happen. So, I mean, there's lots keeping people up at night, and I can't rule out the risk entirely, but I think it's a low probability.
Okay. I have to believe that mortgage lenders, though, are going into defense mode, given what's going on in the economy right now. So, what do home buyers need to be aware of?
Well, lenders are certainly asking more questions, but right now, for as long as appraised values hold up, lenders are still pretty confident. The test of a lender's courage is if prices drop by 10%, because then they have to lend on properties that could be worth less a month later, and their courage will be tested. But we're not there yet. I still find that lenders are quite aggressive. There's some rate specials out right now as lenders roll up to their fiscal year ends in October 31st, and everybody's still competing for business, especially when there's less of it out there. The competition is as aggressive as ever. But funding costs are higher for lenders. Rates have certainly gone up. And lenders are definitely making sure that borrowers are robustly tested. So probably not as many lending exceptions as maybe people were getting a year ago, but I would say lenders are still open for business.
Would you recommend people go variable now or fix?
Really depends
Interesting
on the
times.
borrower. Yeah, the challenge right now, and again, I write about this in detail in my blog posts, but basically right now, if I were in the market, I'd be deciding between a 5-year variable rate or a shorter term fixed rate of 2 or 3 years. And if I did like the 5-year fixed rate, I wouldn't be getting it from a lender that charges the really hefty penalties like the major banks like to do.
Okay. David, what's your view on where rates go from here? Because there doesn't seem to be a sign of hikes pausing right now, even though we might see a recession.
Well, until we get inflation under control, rates are going to keep going up. So I think in the short term, people should expect that rates will continue to move higher. But we do have record levels of debt outstanding in the economy, both household debt and government debt. And at some point, these rate hikes are going to exert their full bite, and it takes about 2 years. So it wouldn't be until early 2024 before we really had a sense for how the BOC's rate hikes were fully impacting the market. When we get to that point, I think there's going to be a sharp slowing in the economy. I actually think we may see it in the second half of next year. And when that happens, I expect that rates will come back down, not to the levels that we saw during the pandemic, but lower than they are today. And I think if borrowers can sleep at night, I think preserving some flexibility to take advantage, either through a variable rate or a shorter term fixed rate, when that does transpire, will benefit borrowers and result in lower borrowing costs.
Yeah, it certainly will be interesting to see, right? Because one of the things that supports people being able to pay their mortgages, of course, is employment. And if we go into recession, I think there is a bit of fear that picture might change. David, I'm going to put you on the spot here. Do you think that the Bank of Canada and maybe even the Fed, do you think they're making a policy mistake?
Yes, I do. Um, I think that they left rates too low for too long, and I think they're worried that they've lost confidence that they can control rates. And I think they're determined that they cannot err on the high side again. I think all of their biases now are towards over tightening, and I think at this point, inflation is a bigger fear for them than a recession.
Yeah.
And I fully expect they will over tighten. 11 out of the last 14 tightening cycles by the Fed have led to recession. And when you
Okay.
look at the tightening cycles, the tightening cycle we're in the midst of right now, we're seeing more rapid increases and a sharper series of increases. So those things, to me, pretty much guarantee we're going to see a significant slowdown in the next 6 to 12 months.
Welcome back to Strictly Money. It's tough for many investors to feel good about their investments these days. Financial markets have tanked, and with interest rates still rising and growing concerns about a recession, many are wondering what to do. Should they sell, hold, or could it be time to buy at these levels? To answer this, Greg Taylor joins me. He's Chief Investment Officer with Purpose Investments. Greg, great to have you on.
Great, thank you.
It's interesting now because, times like this, I find that risk tolerance assessments, they go out the door. People's investment strategies go out the door, and their patience is severely tested. You're an experienced investor. You've been doing this for a long time. How are you feeling about the markets right now?
Well, it's tough to feel really good about the market given the year we've had because you're right, there hasn't really been anything that's worked this year. I think a lot of people have written that this is the worst year ever for the 60-40 portfolio, which is 60-40, which is equities bonds. Because normally when one's working, the other is not, and vice versa, and we get the balancing act that at the end of the day, you get a smooth ride. But right now, there really hasn't been a hiding spot as we've got the S&P 500 down, say 25-ish percent on the year, and bonds down a little worse when you look at the long end of the bond market. So this has been a year that's been really tough, but really you have to look at it in context of a 3-year basis, that there was just so much money printed in the pandemic to try and make sure that the world economy kept going, that things got inflated. And I think we all know when we look back last Q4 of 21, that asset values were inflated, housing values were inflated, and we really needed to get that excess out of the system. So that's being done by a number of measures, with central banks hiking interest rates, with governments pulling back on some stimulus. And we've really seen all asset classes come down in value. So that's whether the value of the housing market's coming down, equities for sure, and also the value of bonds to address this. So hasn't really been a lot of hiding spots, but really when you look at it in the context of a 3-year basis, that things are still up a little bit. So we're not feeling that bad about the market right now. I think you want to be a stock picker right now and start to look at averaging back into equities and trying to figure out different asset classes you want, because while things look bad when you look at it in the context of a year-to-date basis, when you look at it over a 3-year basis, it really hasn't been that bad. And I think we're probably closer to the end of the sell-off than the beginning.
Okay. You said, yeah, we're in a stock market or a stock picker position now. So do you see more downside? Or I know it's impossible to time, right? So would you recommend that people start thinking about buying at these levels?
Yeah, when we're sitting here in the middle of October, this is kind of a danger zone for markets, and has been seasonally one of the months that it really is tough to invest in because there's a lot of cross currents. Certainly, you've got earnings season going through, and there's been a lot of nervousness around earnings for this year, because this is we're looking at Q3 reporting season. This is the quarter that we've seen a lot of pain for consumers, with mortgage rates going up, with inflation going up, and just we want to know what the companies are doing in response to this. So earnings are going to be a big wild card for October. That's probably going to keep some investors back and volatility higher. We've also got another Fed meeting coming up the first week in November, and everyone's waiting for this magical pivot from the Fed. I'm not sure we're going to get in November, but we might get some signals for it in the next few weeks. And then we've got the U.S. midterm elections coming out again in early November. So there's a lot of wild cards right now. They're probably going to prevent the market from doing anything material in the next 2 or 3 weeks. But once you get past this, and once you get more certainty from the U.S. midterms, once we get more certainty from the Fed path, and once we get past earnings, it could be setting up for a nice year-end rally. So probably not a bad thing to start looking at what companies you'd like to add on this dip, and maybe getting set up for a year-end bounce. And that's probably the right strategy versus panic selling everything here, because if you sell here, you could be selling closer to the low than you'd like to, and you might miss out on some upside into the year end.
Yeah. Yeah. And we know that markets don't like uncertainty, do they,
Yeah.
Greg? We have about a minute until the commercial break. You mentioned volatility. Do you pay attention to the volatility index, which is sometimes known as the fear gauge, because it is near a 2-year high, and so what are you watching for?
Yeah, the VIX is a really tough one to monitor because certainly you're right. It looks at what people are paying in options for protection, and really that's where the measure of it being looked at as the fear gauge is pretty important. As people say, when people are buying more puts, VIX goes up, and that's people being worried about the market, and that's a good measure to look at it. Though I think in the last month or a few quarters, we've seen more and more people getting involved in options trading, and there's more demand for puts and calls, and that's keeping the VIX, I think, more elevated than it should be normally. Normally, in times of calm, the VIX settles out in the 10 to 15 range, but we haven't been there in a long time. So I think the VIX is a good measure of volatility, but it's probably a little skewed right now because there's more people in the options market than it normally is.
Oh, okay. Good to know, and good to know that we might actually see a year-end rally. Let's hope for that.
Hope
We're going to
so.
take a quick break, and we'll be right back. Welcome back. Greg, a lot of strategists I've spoken to believe that the TSX will continue to outperform the US markets. Are you in that camp?
I am, and the TSX has done and well year to date. It's still negative on the year, but doing way better than the S&P 500 or the Nasdaq markets or other global markets. And I think that really does add some credit to just the resource sector. The TSX is heavily overweight the resource sector versus other indices, and that really has been a nice hiding spot versus some other areas. Certainly, the U.S. markets have really been benefiting from the tech sector for the last number of years, and I think that while these companies are great companies and good businesses, they got a little inflated in value and also really overowned. So while the FANG stocks really were able to cushion the S&P 500 and tech and Nasdaq for the last number of years, I think it could be a bit of an Achilles heel going forward, because when you look at an environment with rising interest rates and rising yields, what that normally does is add some multiple contraction to some of the higher value growth sectors, which is really technology. So I think those sectors could be under pressure for the next foreseeable future. So heavily weighted in tech sectors could underperform. And when you look at the TSX, which is more value skewed and skewed towards cyclicals, it could be a pretty good setup for this the TSX to outperform going forward, for at least for the next year or two.
Yeah, you mentioned cyclicals, though, but if we go into recession, could that change the picture, especially for commodities?
Well, it could, but I think we're actually having a really interesting period right now where there's been so much underinvestment in some of these commodities that even a little bit of a bid to the group is going to be something that's going to be met with some decent returns in some of these commodities. Really, just looking at energy is the best example. That after a number of years of underinvestment in energy, because investors really had turned away from it towards technology, and also the ESG mandate some people took as a way just to not fund these companies. So there hasn't been a lot of new money going back to exploration in energy or copper or some of these other commodities. And you really can't turn it on that fast. So as people are now starting to look at, well, where does Western Europe and North America get more commodities as we've turned off the Russian supply? It's got to come from somewhere. And I think this could be a nice bid to the Western Canadian energy companies and also some of the base metal producers that are operating outside of Russia. So as much as the global recession could add some slowness to demand, there's really the supply side is something that people are struggling with, trying to come up with new supply. And this is where I think it could be a setup for some of the Canadian companies to do quite well.
Yeah, interesting point. What about real assets and REITs? Because REITs typically have real assets in them.
Yeah, REITs have been a tough sector this year. Certainly, when you look at real estate and you see rising interest rates, we're seeing a pullback in housing prices and also the value of real estate. So REITs have been underperforming, but that's probably a sector that people should be putting on their buy lists and trying to pick a point that they can start allocating back to them when they get comfortable that we've had a peak level of interest rates. And that's going to be the biggest thing that everyone's watching for. We've had a lot of people talk about when's the peak in inflation happening, and there are some that argued maybe it did happen in August. We're just not seeing it come off as much. But tied to that and the peak of inflation is also the peak of interest rates. And I think that's more important, because if we do start to see the bond market start to calm down, maybe the US 10-year bond yield can peak out somewhere in this 4 to 4.5 range. Once you get yields to start to pull back, I think that's going to be a nice environment for real assets and the commodities, and including the REITs, to do quite well. And I think this is something that people need to keep on their buy list and look at sectors to allocate to.
Okay. Greg, we only have about a minute left. Do you think central bankers have learned their lesson with keeping interest rates so low and creating bubbles? What do you think happens going forward?
Well, that's a tough question, because it does feel like they've been behind the curve for the last 20 years. They haven't really inflating bubbles, and then they react too much to bring them back in, and they try and normalize, and they've had a tough time. And it's really something that I think investors have gotten used to. And one of the other things that investors have gotten used to in the last number of years is something called the Fed put, which is anytime there is volatility in the markets, the central bankers seem to step in to try and create some stability and let equity markets go higher. But they've been pretty clear in the last 6 to 9 months that that's not the case, and they're not going to step in to help equity investors. So there's a big change in mindset here for investors and how they view the Fed, and I think that's going to create some volatility going forward. Certainly, we know the Fed left interest rates too low for too long, and now they're trying to recover that. And the risk is they're going to break something along the way.
Yeah, so maybe they've learned maybe they've learned a few lessons. Yeah, Greg, great to have you on it. Good.
Great, thanks very much.
Appreciate it. Greg Taylor, CIO of Purpose Investments. Well, that does it for this show. Do you have a story you'd like to share, or questions about this or previous shows? If so, please drop us an email. Thanks for watching. Until next time, stay well, stay wise, and stay wealthy.